Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. One of the hottest topics in the investment management space over the past 3 to 4 years has been fixed income markets. Bond prices, they experienced a tremendous 40-year run while interest rates were on a steady decline since the early 80s. And many characterize that time period as boring for bonds. But that all came to a crashing halt following the pandemic, and the bond market can no longer be characterized as boring. Well, I have a very special and fantastic guest on who is also very esteemed in the fixed income markets. A fixed income portfolio manager, award-winning fixed income portfolio manager, and chief investment officer to talk about the fixed income markets. So I'm honored to have on award-winning fixed income portfolio manager David Albrycht on the show today. David is the president and chief investment officer of Newfleet Asset Management. Mr. Albrycht is the senior portfolio manager for several multi-sector fixed income strategies, some dating back to the early 1990s. In his role as CIO, Mr. Albrycht drives top-down strategy for Newfleet's investment platform, which includes multi-sector and dedicated sector strategies for high yield and bank loans. Dave, thank you so much for coming on. It's such an honor to have you on and such an exciting time. Can you please tell us a little bit more about yourself and Newfleet?
Sure. First of all, and thank you very much, Ryan, for having me on. Pretty excited about it, and you're exactly right. Bonds are now exciting. With yields back to levels that we haven't seen since 2009. Bonds are exciting. What I thought I'd do is just give you a quick intro and tell you a little bit about myself, how I started. Back in the Phoenix companies, back when I was 18 years old. I was working and I went to school full-time nights. Did my undergrad, my MBA, and my CFA. In the middle, or just after getting my undergraduate, I got an internship in investments, and that turned into a full-time job 36 years ago. I worked in private placements, which is direct lending. Then I worked in public credit and became head of public credit. As you had mentioned, in 1992, I started managing multi-sector portfolios, which I've been doing going all the way back and for 36 plus years. And Morningstar did tell me that I'm the longest tenured multi-sector manager in Morningstar.
Wow.
For whatever that's worth. Virtus spun off from Phoenix back in 2009. I was obligated to stay there until 2011. I left with 14 handpicked investment professionals to come to Virtus. And I've been part of the same investment team that's been managing multi-sector now for over 3 decades.
Wow.
Yeah, and as far as our strategy and our style, I think it's important that we talk about that. I would just call it value investing in fixed income.
Okay.
We overweight sectors that we feel are undervalued after intensive analysis. Broad sector diversification, so all 14 sectors of the bond market. Typically, we're going to have a quality orientation so we can have liquidity in the portfolio. I'd say like right now with high yield and bank loans, we're up in quality. So we have that liquidity. Proven sell discipline. If there's a fundamental reason or a fundamental change, if there's an irrational bid, if relative value tells us to sell, we'll sell. And lastly, and I think importantly, we're not interest rate anticipators. We're duration neutral. So I'd sort of summarize that by saying we actively rotate amongst sectors based on relative value between sectors. We look at fundamentals, technicals, and relative value. That's really how we make our decisions. And as you had mentioned, not only do we do multi-sector, we also have dedicated LevFin strategies, a short duration high income fund, a high yield fund, and also a bank loan fund.
Fantastic. Thank you so much for the insight. And, a lot of those strategies have been awarded as PSN Top Gun Award winners over the years. So they're fantastic strategies. And we're going to talk about it shortly about all the different sectors that you feel are good opportunities right now. And I would think as a value shop and value fixed income investors, now is a fantastic time, or really the past, couple of years have been a fantastic time for you and your firm.
Yeah, if I look at, two of the things that I think right now are very appealing, all in yields are yields we haven't seen going back to 09. and discount dollar prices. So if
Mm.
I'm a bond guy and I can find value, it's not a passive investment, actively managing, buying high yield at 92, buying bank loans at 96, buying, emerging markets in the 80s. Those appreciate, and if I do a good job, they're going to mature at par. So not only am I giving you a very attractive all-in yield, I'm also giving you the potential to give you a par back when the bond matures.
Fantastic. Taking a step back in a bigger picture, despite the strong equity returns and like you were just talking about, some attractive bond yields, it's really not that easy of a market for investors. And investors are faced with a lot of obstacles. Where do you see some of these risks and opportunities in 2024?
Yeah, so when I look at risk and opportunity, I usually break it into first the domestic markets, then I look at the global markets. And I would say without question right now, the single biggest issue out there is the magnitude and the timing of the economic slowdown. And it's, will we have a soft landing? Will we have a hard landing? Firm landing? No landing. And I say so it could go any which way. A lot of good news is priced into the market. We've seen a nice little rally at the end of last year, beginning of this year. The Fed has told us over and over they want 3 rate cuts. The market's still saying 5.5, so we'll watch that closely. And they'll be data dependent. But our expectation is soft landing, and it's for a few reasons. Consumers still in good shape.
Yep.
Okay, unlike the global financial crisis. A lot of the leverage finance companies have refinanced their debt and pushed out the maturity wall, so you don't have that big maturity wall coming like we did during the global financial crisis. And now, lo and behold, because of all the private credit deals, there's another $1.7 trillion of liquidity in the market. So especially for the smaller mid-market companies that can't get access to financing, that have very high leverage, now there's this newfound source of capital, which is private equity. So I love when I get a call and saying, hey, you have a triple C, bank loan issue, it can't get financing, it's struggling at 92 cents on the dollar, and oh, wait a second, it just got taken out at par because private credit came in. I'm like, thank you very much. So that's a blessing for us. If I look at some other stuff, the banking crisis, I'm not really worried about asset liability management that we saw with Silicon Valley Bank, Signature. I think right now it's more commercial real estate exposure. And we've heard it. We've New York Community Bank being one. We've heard some of the weaker regionals. We like some of the better capitalized regionals. We like the GSIBs, but we're very cautious about this $117 billion maturity wall that's coming due. We sort of categorize it as, we hope they can survive until 2025. So watch that closely.
Okay.
2 other things I think domestically. One, the government shutdown. We saw that in January, pushed out to March. We'll hear that again in a few months. Refunding risk. When the government's refinancing its debt, rates are much higher, the cost is much higher, and we've seen volatility around refunding. So we'll watch that closely. I think if I had to categorize the global risks, obviously you can't forget about what's going on in Israel with Hamas. The spread contagion there is the big issue. The Red Sea, I think that's underappreciated. Shipping costs are up about 4-fold, while shipping time is up 3-fold. So very detrimental. And we have to watch the Iran and the Houthis there. So that's something we're watching. And really what the impact on energy prices are. That's always a concern. We know that, people always relate back to the 70s, where 73 and 79, we saw oil go to $150 a barrel. That's inflationary. Right now in the 70s, I think we're doing good. Russia, Ukraine, probably the single biggest issue I think they're going to deal with today. The funding risk. Will they actually get money to continue what they're doing? And obviously not getting better. We saw Russia try to weaponize energy. That didn't work with a warm winter. They're a third of the wheat production. That goes to the emerging economies. That's very, very detrimental. When Egypt has food prices going up 30 to 40%, that becomes social unrest. So that's something we're watching closely. Can't forget about China. End of zero COVID policy. I would have said strong economy. Economy's been weak. PMI has been very weak. We have real estate problems. We're having the liquidation of Evergrande right now. We have shadow banking problems, band load creation. And now they're trying to employ a variety of stimulus. We recently saw the reserve requirements cut by, I believe it was 50 basis points, adding $140 trillion of additional liquidity. So it's a big driver of the world economy. We can talk about it in more detail later on. And then last but not least, and this is something me and you had talked about prior to the call, 2024, the political uncertainty. Half the world's population will be voting in either federal or local elections. obviously that's going to, cause a little volatility.
Mhm.
But for me, I'm a fixed income guy. I'm a multi-sector guy. Volatility is opportunity.
Mhm.
When we see some type of uncertainty and things cheapen up, we're a dip buyer. So we'll be allocating if we see some type of, market volatility. So it's not necessarily a bad thing.
Yeah, I agree. Across the board, multi-sector volatility, if you use it correctly, it can be a big advantage, right? And an opportunity.
Absolutely.
You
Absolutely.
mentioned the kind of the divergence between Fed and markets and their outlook. Where do you stand when it comes to the Fed? And do you believe the Fed's recent commentary that they're not quite ready to cut rates and they're potentially three rate cuts this year? Do you believe them, or are you fighting the Fed?
I think the market's been wrong for 24 months, and the market tends to, look out and be a little more optimistic. So I think they're data dependent. If I look back at what the Fed has done, they've had 11 rate increases. They've moved 525 basis points. They're on hold right now, as we well know. They told you they're data dependent. They're going to fight inflation, and they don't want to move too quickly. Okay, it's an election year. They've mentioned three rate cuts. The market still, if I look at the WIRP right now, it's 5.5, 6, which seems a little too aggressive. Maybe March, unless we see some data. We didn't see the payroll numbers today sort of confirm the deflationary environment and the slowing. If I look at some key indicators, growth still relatively strong. I think fourth quarter growth was 3.3. Oil is not at a level that's too high. It's in the 70s, WTI and Brent. Unemployment is still 3.7%. Inflation behaving well, right? Core PCE, you look on a 3 and 6 month annualized basis, is right around 2%. As you'd mentioned, rates remain elevated. If you went back to, 2022, we're up dramatically. And then one thing that, people get a little nervous about is we're 21 months into an inversion. So the curve's still inverted, nowhere near as what it was, 4 or 5 months ago. Actually, 10 months ago. Right now, I think it's twos to tens or 31. So a little flattening and working in our favor. Two other things that I look at: inflation, good news and bad news. Good news, headline inflation is down from 10 to about 3. Supply chains have corrected. Energy has moderated after the invasion of Ukraine by Russia. I think we're up to $126 a barrel.
Yeah.
Bad news, core services remain elevated. Labor market remains tight and payrolls remain strong, as we saw last Friday. I think the Fed is poised to cut rates. They've told us that. It's likely it's going to be mid to later in the year. Most likely they're going to do 3 cuts, but the possibility, depending on data, there could be 5.5 cuts. Sort of my summary and how I feel there is that there's value across the entire yield curve. It's not just with duration. It's not just in the front part of the curve, but good values in the front part of the curve, value in the intermediate part of the curve, and also value in the longer part of the curve. So don't be, I have to buy duration. Well, you do, but balance that with some of the value that we see in the front part of the curve. Fed starts cutting rates, we're getting, securitized yields of 6-7% for single A, double A, triple A. That's really attractive.
Yeah. Exactly correct. Great thoughts there. My feeling is if the Fed has to cut rate 6 times this year, something went wrong. That soft landing, we're in a recession. 6 times, like you said, I agree. It seems to be a little bit aggressive, but hopefully they don't have to do 6 because I feel as if something went bad.
Maybe
You
a
talked
little.
about the yield curve. Yeah,
Yeah.
go ahead.
No, just a little too wishful thinking. I would agree with you.
Yeah. Yeah. You talked about the yield curve again. We're talking fixed income. You can't have this conversation without talking about yields. What's in store for yields? And you talked about the inverted yield curve, which seems to be going on for, like you said, 20 some months.
Yep.
What is in store for yields in 2024? And do you believe the curve will normalize?
Yeah, that's a great question. I mean, I'm not a big interest rate anticipator. I've been doing this for 30 years. I always listen to people give you 20 reasons why it's going to go somewhere and it goes the other way. And based on new data, this is why we're revising our outlook. I love to look at the 10-year treasury. We came into last year at 388. Within a month, it was down to 330. Throughout the year, higher for longer, rates got all the way up over 5%. And lo and behold, we ended the year at 388. So it began the year where it started. Everybody predicted rates are going up. You need a duration. You need to be front part of the curve. again, I think there's value across the whole curve, and I think that's very, very important that you don't try to anticipate the direction of rates. You can participate in both curve flattening, which I think we will see.
Yeah.
You asked me, what do I think about, getting normalizing the curve? It's been an unnormal past few years. A lot of the inversion was caused by what we saw during the pandemic, the flood of money, the fiscal deficit. We're not that inverted right now. It's been 21 months, typically 12 to 18 months out signals a recession. I gave you the reasons why I think we can orchestrate a soft landing. So as the Fed begins to cut rates, we're not only going to see short rates come down, but we'll also see long rates start to come down with that. As long as we're in a deflationary environment, we don't see a massive reacceleration of inflation. So that's good news for a fixed income investor because you get the benefit of declining rates. You get the benefit of discount dollar prices, and then those assets returning to par.
Hmm. Some fantastic total return options,
Absolutely,
opportunity coming up. Yeah.
absolutely.
As a multi-sector investor, what are some sectors that you and your team find attractive, and where do you see the opportunities in 2024?
Yeah, I mean, I'll go through some of the sectors that we like. I think first and foremost, investment grade corporates. Now, everybody says up in quality or biases up in quality. There are biases down in quality. We're triple B investors. We have a big chunk of our investments in triple B. That has seen the most fundamental improvement of any sector. So that's good. When we saw Silicon Valley Bank and the debacle with the asset liability mismatching, we started looking at some of the regionals that were well capitalized, had strong balance sheets, had smaller average deposit bases, like a Fifth Third, a Huntington, a Citizens. Those all made sense. Not big commercial real estate exposures.
Yeah.
When we saw volatility throughout the year, the GSIB banks made sense to us. Typically, if you look at banks, they trade at 15 through the index. They're 15 wide to the index right now. So that's a 30 basis point swing on a market that's trading at 90 off. That's really attractive.
Hmm.
So we did like a JP Morgan, a Morgan Stanley, a Goldman Sachs, a Citi. Those all made sense. And right now, as I had mentioned, when you're getting a 5.24 yield in investment grade, it seems pretty attractive.
Yeah.
So we like investment grade. If you want to add duration, you can add in industrials. Spreads are a little tighter, but unlike everybody thinks, defaults are going up. Defaults in the investment grade market were fraud. There's only been one in the last 7 years. If you went back over the last 25 years, you had Enron, WorldCom, Adelphia. Those were all fraud.
Yeah.
These companies can get downgraded, but they don't default. So we like IG. We like the triple B space. I think our bias is definitely financials over industrials. If I look at a few more, securitized, the non-agency market we love. Credit underwriting is solid in the mortgage space. Record equity in homes. Shortage of housing. I think the stat that we looked at was they were building 1 million houses per year back in 07. 09 and on, they built 250,000 houses. So the shortage of housing is about 700,000 units per year. So we love single family housing, single family rentals. Those all make sense. Right now, you're getting around a 6% yield on a AA asset that's priced at about 93. So the agency market, is traded off. It's been volatile. It's off about 1.5%, while the non-agency market is actually flat this year. So it's something that we definitely like. Insatiable demand here. People want to get mortgage product, and the underwriting has been a lot more stringent. So that's one area we like. I'd also throw out asset-backed securities.
Okay.
We specifically love subprime auto. Now, don't get that confused with subprime mortgages, not the same animal. If I went back over the last 3 years, about every year, about 75% of our book gets upgraded. We stick in the top of the stack, front end of the curve, high quality. Right now, we're getting about 6.5% on a $97 price and a 2-year duration. That's A-rated. Think about the value of your used car in the last 3 years. It's up 46%. That's my collateral. So first, I look at the structure. Where am I in the capital stack? I look at the consumer, and these have been an absolute home run. A few others I'd say is whole business franchise lease receivables. You own a Dunkin' Donuts, a Domino's Pizza, Carl Jr. What do you call it? You make a payment to the parent to use the name. They monetize that asset, sell it to a guy like me, and build more properties. those have been an absolute home run. So great value in the front part of the curve, and one we're probably now starting to jump on board with, and I think it's interesting, the commercial real estate sector. Now, I used to call it the Rock of Gibraltar. It was 20% of our portfolio 10 years ago, always outperformed corporate bonds. Then I started getting nervous about 6 years ago. And I walk into Nordstrom's, I wear a shirt, try on a shirt, I go home and order it on my computer. Like, I don't need the brick and mortar. So if you've seen a lot of weakness, I believe there was stat was only 10% of malls are actually profitable. Everybody else is losing money, even though every time I go there, I can't find a space to park. But, and my father used to go there with 65 people and walk. And I'm like, did you ever buy anything? Absolutely not. I'm not paying $10 for a Starbucks coffee. But it's just like, okay, we don't need the brick and mortar anymore.
Yeah.
So we're looking at some of the new deals. We just started buying them. And unlike the global financial crisis, especially in asset backs, non-agencies and CMBS, agencies are requiring more credit enhancement as the market starts to weaken. So deals are coming, more credit enhancements required. We're getting, what I think, single asset, single borrower deals, rural office, data centers, industrial warehouses, staying away from office. We're getting, 7% yield on an asset that's about a 1-year AA rated, which we think is tremendous value. And you've seen this market, along with asset backs, demand is off the charts. So even though supply is at record levels in ABS, demand exceeds that, similar to what we're seeing in the loan market and the high yield market. And then the commercial mortgage market, people are getting excited again. They're worried that the maturity wall is coming up, but they're also seeing the highest quality really perform well. So I think, those are probably three of the areas where there's good value, IG and the securitized sectors.
Great insight into all the different sectors. It's amazing when you think, a lot of people, especially like me, who tends to focus more on equities, all the different sectors out there, all the different fixed income sectors, and you need a professionally managed portfolio manager who's got that understands all these different sectors to really diversify your portfolio.
Yeah. The one big advantage for us is we have a 6-man team that follows securitized, and I've got 3 guys that have been with us, for over 30 years. And actually, the street will inquire with them during the pandemic. They were inquiring, "Hey, how should we structure this deal? How will people want to buy this?" So, and then we rip deals apart with Intex. People like, "Don't talk securitized." I'm like, it's great value. It's
Yeah.
it's not a risk if you stay, in high quality and very liquid assets.
You brought up briefly high yield bonds. Credit spreads remain relatively tight when you look at it, which may turn some investors away from high. What are your thoughts on high yield?
Yeah, it's a great question. I mean, credit spreads are tight. Absolutely. They're inside of 400. However, you got a $92 price with a yield of about 780 as we speak this morning. High yield is the highest credit quality it's ever been in history. You had $284 billion of downgrades during the during the pandemic. Kraft Heinz, Occidental, Ford, Twitter, Nordstrom's, all these great companies are now double Bs. Obviously Ford, went the other way and got, upgraded. But so there's good value there. It's high quality. Our bias, not only in the high yield market, but in the loan market, has been up in quality. You're not getting paid to take risk, but if I can buy a Hilton Hotels at 7%, if I can buy some high quality names, a TransDigm at 8%, a Hertz at 10%, good quality names, large cap names, and then my philosophy there is, what's more important than picking the winners is avoiding the losers.
Okay.
Staying away from a Michael Stores, a Vice Media, a Rocket Software, a Triton Water. Avoid the losers that are down 20 to 30 points. Pick some of the solid core names. If there's any type of correction, we can reallocate to those names. So we like it, and you have to look at the high yield market with the bank loan market, okay? Because I think one thing, you can't have two separate units looking at it and give us your best ideas. We look at the capital stack and say, I have a secured high yield, a secured loan. Then I have secured debt. Then I have unsecured debt. And then I have private credit. Which part of the stack looks most attractive to me? Where am I going to invest? And again, in the bank loan space, with LIBOR and rates where they are, I'm getting double Bs with a coupon of 8 to 9%. So every day I look at it, I'm like, up another few basis points. We're up 80 basis points this year. Last year's best performer in the, probably if you go back over the last 15 years, only down 2 years. So this is a good part of the portfolio. We like bank loans. We're watching out for the 2021 vintage. You heard about loose documents, loan-only structures. Know what you own. High yield and bank loans, you don't want a passive investment. You want active management. You want somebody that's doing the fundamental research. And I want to buy something for fundamentals. And just like the high yield market, it's avoiding the losers, avoiding Avaya, avoiding Envision, avoiding Genesis Care. These are blowups that we avoided. So you're in a passive portfolio. Oops, you own those. It's like we've made a conscious decision to get away from those. So both of these we do like. If the Fed starts cutting rates, whether it's 6 months out, maybe we'll start thinking about paring back a little on loans because obviously your coupon will go down. But we'll stay up in quality right now and buy in dips.
Fantastic. We often talk about here, we do a lot of drawdown analytics, and when we're talking about risk, and it's like you win by not losing,
Yeah,
right?
yeah.
So
It's a lot of people don't understand that. And that's the sole reason active over passive.
yes, exactly. Real quickly, I just want to cover this before we talk about something fun. You mentioned the Chinese economy. Does that impact your views on emerging debt?
Yeah, that's a great question. I mean, if I look at China, I look at the economy, we know they've had problems in the real estate, tech, and gaming sector. Shadow banking is an issue. It's a big driver of the world's global economy, and PMIs are low right now. So I think the thing we'll see from China is additional stimulus. So we watched that. Coming into the pandemic, we were very, had a very low allocation to emerging markets. And during the pandemic, we had no local currency because Fed's raising rates, the dollar's strong. Why fight that? So only now have we begin to take a hard look at some of the sovereign names, like a Pemex, a Colombia. We just recently bought Ivory Coast and Romania, and taking a hard look at the emerging markets because they're typically ahead of developed economies. So Colombia, Mexico, Chile, Brazil, to mention a few on the local currency front. So we like it. It's a great diversifier. Just to put it in perspective, you're getting 1075 on high yield EM, but it's very country specific. And you're getting a 553 on the IG space. So it's attractive again. We like it, but we're gradually easing our way back into it.
Interesting. All right. Fun story time, Dave. Anything interesting that you can share that you find fun? It could be industry related or not.
Yeah. I think one thing I want to talk about was I have a nephew who's in the armed services, and I always like to thank our males and females that are serving the country. So last year, what I ended up doing, I got in touch with my nephew's wife. She was able to contact somebody that was at his base. What I did is I donated, hamburgers, hot dogs. I think it was either Miller Lite and Miller or Bud Light. I'm not exactly sure, but supported the whole base. And the funny thing was, I started this process back in June, and it got there to the base on July 4th. And what they sent me back, which I thought was amazing, was the flag that flew over the base that day. They sent me a card from all the senior officers thanking me for what I did. And then I got a resolution, which was this flag was flown in the face of the enemy and carried on operational missions during Operation Resolute Support in honor of David Albrycht, July 4th. The flag represents the will and the resolve of the American people to protect those who cannot protect themselves, and to stand strong and defeat all those who attempt to harm them.
Wow. That's fantastic, Dave. I love that story. And I thank you, I think, for doing that for all of our service men and women out there. And thank you, service men and women, especially right now. There's so much unrest out there. Thank you for everything you do. Thank you, Dave. It's a touching story, and I love it that Oh, being from Wisconsin, I hope you sent Miller Lite.
I don't remember what they got. All I know is they received it on July 4th, and it was pretty amazing to get that,
Uh,
not only the card, but the resolution and also the flag that flew that day. I appreciate
Yeah,
it.
just the timing of it too. It couldn't have been any better, right? And the
Absolutely.
fact that you had this started in June, and I'm
Yeah,
sure it was quite the process, but
it was a great
fantastic
thing.
story. I love it.
Well, thank you very much for having me again, Ryan. I appreciate it.
Yes. Well, thank you so much, Dave, for coming on the show. It's been such a pleasure to have you on. Where can our audience get more information about Newfleet Asset Management?
Yeah, you go to the Virtus website,
Okay.
virtus.com, and Newfleet is one of the affiliates of Virtus, a wholly owned affiliate. And all of the information will be there. As I had mentioned, we've been doing this for 3 decades. We've got some great funds, had a great year last year, and this year we're off to a great start. So, hopefully you guys will take a look. I appreciate that.
We will for sure. And we'll put links in the show notes
That
to
sounds
your
fantastic.
website.
All right.
Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our podcasts on the Adjusted for Risk YouTube channel, as well as on Spotify and iHeartRadio. Thank you very much and have a great rest of your week.